everyone. Welcome to our first episode of Investment Unlock. I'm joined today with Chris Hamilton, our Head of Client Solutions for Asia, and I'm Chris Crea, our APAC ETF Specialist. Hey, Chris, welcome to the podcast.
Chris, thank you for having me. I am looking forward to unlocking investment opportunities with you and unlocking all sorts of types of opportunities with you on this podcast.
Fantastic. Love that. All right. Well, look, there's so much happening in markets today and has been for a little while throughout all 2025, it feels like. So I might get right into it. Chris, what are you seeing in markets today?
So, great question. And obviously, there's a lot of consternation right now in the marketplace with the prevailing narrative, with our clients. And let me, delineate a bit. So I think a lot of the issues we've seen with respect to trade policy, geopolitics over the last 6 weeks has really been an acceleration of a trend we saw started to take hold towards the end of Q3, where you have a decelerating macroeconomic environment in the US. You had arguably a cyclical bottoming in developed markets ex-US. And the confluence of those two factors was really accelerated by the policy news on what we're calling Liberation Day. So we've been defensively positioned in our portfolios for some time now. So that's actually been very helpful for us. Now, the question is, when do we see that abating? We think this will probably last now for the next few months, let's say, before we reemerge. But in the meantime, we have taken risk off the table.
Yeah, got it. And that was going to be my next question, which is really around how are you currently positioning your portfolio? So it sounds like you've been defensive for a little while already, seeing a little bit of uncertainty in the markets. So how are you positioned across your client portfolios today?
Sure. So I can unpack how we define defensive positioning in a portfolio. And this environment is unique because typically you're positioning against equity risk or interest rate risk. And in this environment, we're actually very concerned about both. And that's having a market impact on the way we've built portfolios. So when we're building a defensive portfolio, we're going to have a bias towards developed market equities. And in this case, a bit of a bias towards, let's call it DMX-US equities in our tactical sleeve. Underneath the hood, that's where we're going to make a lot of dynamic tweaks to our equity exposure. Some investors choose to deploy that using sectors. As you know, we choose to deploy that defensiveness using factors. So we're going to overweight factor characteristics like high quality equities, low volatility, as well as momentum to really increase the drawdown protection aspects of that equity sleeve. So that's how we take risk off the table in equities. Fixed income, like I said, we're also worried about rate volatility. So we're higher quality in our fixed income portfolios, but we want to be sure and integrate assets which are going to mitigate against interest rate volatility. So shorter duration, but think about assets that are high quality. So think about something like high grade collateralized loan obligations, which have a positive relationship with interest rates. As interest rates go up, the payments on those underlying loans go up. So really being thoughtful and intelligent on that side. So not just going in and piling into long duration bonds per se, but being surgical and nuanced in terms of how we achieve that high quality exposure. And ultimately, we want the equity and fixed income component to diversify itself. So in that environment, that's how we're putting that defensive exposure together in our underlying portfolios.
So as always, diversification is the key, and particularly in markets like this. And you touched on this a little bit. U.S. country risk is typically a big portion of our clients' portfolios, where it's through the U.S. dollar. You just spoke to a lot of people see high quality bonds as treasuries, which has been a challenged asset class currently as well, especially on the long end of the curve, like you said. And then, of course, equities are struggling a little bit now as well. And we're seeing tons of flows to try and mitigate against this. And you spoke to factors. And I want to pivot for just a second. Looking at US equities, we're going to talk about opportunities outside of the US equity and US market in general in a moment. But within US equities, we think that a great way to start incorporating downside protection is via utilizing factors, and you mentioned things like quality, low volatility, we've been seeing ETF flows into those exposures, so single factor, quality, low volatility, a bit of momentum. Interestingly, high quality hasn't worked as well as people expected. I think there's it's a bit of a polluted exposure right now with Mag 7 constituents. How do you think about blending factors? Because we know, we speak to clients, you can't just go and buy every single factor ETF out there and just start mixing it together, because you'll end up with potentially offsetting effects or less efficient factor exposures. So how do you think about blending factors as part of your portfolios?
That's a great question. So I think you allude to a really important step when thinking about constructing factor aware portfolios. I think some investors choose to layer factor exposures on top of each other. So blending a low vol index with a quality index with a momentum index. As you point out, there are certain isolated factor exposures right now which aren't as performing, I would say, in line with their expectations given the particular regime, quality being one of them with its high overweight towards technology. What we do to evade that is we actually score stocks at the individual holding level. So when I say we prefer exposure to quality, low volatility, momentum, we actually score that and we look for stocks that have all three of those embedded underlying characteristics. So stocks that have high quality but also high vol won't make it in the portfolio. So that's how we abate for some of that, is that individual stock level scoring versus blending exposures together, which has some of those unintended consequences and doesn't allow you to harvest the full benefits, especially in an environment like this where low vol is very much doing its job, but quality in isolation isn't doing what you would expect in a drawdown type environment, if that helps.
Yeah, that makes sense. Thank you. So it sounds like, as always, we advocate for incorporating single factors into client portfolios, and you can do that very easily utilizing low-cost ETFs. But it sounds like if you would like a multi-factor exposure, it might be a good idea to outsource that to potentially active strategies with ETF format, things like systematic active equity, where you have a PM constructing those multi-factor portfolios from the bottom up and ensuring that you have a very efficiently shaped factor portfolio.
Well, that's a great point. And I'm really glad you brought that up, because those are available not only in, I think, traditional active structures, but you've seen a huge growth, as you know, and are sitting right at the center of this, in active and smart beta ETFs.
Yes.
So I would actually argue that you have the ability to deploy a variety of approaches in the factor construction space using whatever fund vehicle is appropriate for you and your clients.
Absolutely. Fantastic. Well, great to speak about factors, and we see factors being primarily used within the US equity sleeve. You can obviously implement factors globally as well, but why don't we move on a little bit and speak a little bit to what are you seeing in opportunities outside of the US?
Sure. So outside of the US, we've seen, I'd say, a reemergence in momentum, which really started in Q4. Obviously, you've had some huge accelerants to that, mostly driven by geopolitics, whether it be trade policy, whether it be kind of global defense policy. So the trend has very much been with the developed ex-US space. Many European economies and European markets are up year to date meaningfully, vis-a-vis with the US being, let's say, down about 5.5% as of the time of this podcast. So we typically are still going to have a preference for those defensive factors outside of the US, but we have increased that developed market ex-US exposure since Q4. So we have been more prospective on that vis-a-vis US. So that's typically how we have thought about it. I'd say our exposure to emerging markets, which is probably a relevant subpoint here too. From a tactical perspective, I would say we've had an underweight towards the benchmark, but we see pretty meaningful strategic long-term opportunities in that space. If you think about something like China equities with very attractive valuations and potential, fiscal and stimulative catalysts, that's an interesting full cycle opportunity. We would argue. So no matter how you think about it, we do think that global diversification in your equity sleeve and not just kind of being completely anchored or leveraged to one market is absolutely a sound approach, going forward. We've actually had, I'd say, anecdotal conversations, externally over the last couple of months. We've had clients ask us, should we just start benchmarking our entire equity portfolio to the S&P 500? And we would argue that having a global portfolio and a global benchmark does make sense over a long period of time. We've seen that really come to fruition very loudly in 2025. I would say on the more like income side, of the equation, we do see interesting opportunities in Asia investment grade bonds and the like. I think there are longer term opportunities in EM debt. There are some strategic risk premia there that we think you can harvest depending on your underlying base portfolio. So that diversification story not only resonates within equities, but also within fixed income as well. I think now investors have, learned the lesson of over concentrating in a particular geography as we go through 2025. So I think going forward, diversification, while theoretically it always makes sense to investors, now they have a real life case study that they've lived through in the near term that I think showcases the efficacy of diversification on a high level.
So that's a great point, and you spoke to this a little bit earlier today. So you have your strategic asset allocation, then you have your tactical asset allocation overlay. How are you trimming your SAA, which is obviously longer in time horizon, and how are you then reallocating some of those exposures strategically, and then what are you doing tactically as well?
Sure, it's a great question. So when we think about strategic and tactical asset allocation, we're going to think about it in terms of a risk budget versus a benchmark. So an active risk budget, and I mean typically it's going to be fairly split evenly between tactical and strategic asset allocation. So we define tactical asset allocation as, let's call it 6 to 18 months. And we'll call strategic asset allocation 3+ years, depending on the underlying signals that we're using. So on the tactical side, we're going to think about, as I've kind of alluded to throughout this conversation, macroeconomic regimes, risk sentiment, leading economic indicators, a lot of forward-looking survey-based data that is not highly subject to revision like GDP prints or weekly employment reports. So that's going to drive our tactical mix, with the whole thought that if investors are increasing their unit of risk in their portfolio, they think they're going to get paid for taking it. And that's ultimately prospective and opportunistic and positive for the global macroeconomy. The inverse would be true if they're reducing risk in their portfolios and overweighting asset classes like long duration bonds. On the strategic asset allocation side, that's where we're going to think about strategic risk premia. So where can we cleanly and efficiently harvest a risk premia over a base asset class over a 3-year period? And like one classic example, I alluded to earlier in the conversation was high grade collateralized loan obligations. So very high grade, high quality, floating rate. And over time, you've been able to harvest a premium over comparably rated investment grade bonds by about 80 to 100 basis points. So getting paid to hold that asset class over a multi-year period is, I think, a really good example of how we think about SAA. Another example from an SAA perspective would be factors. So we actually think about factor exposure, think about quality, value, momentum, as we've talked about throughout this conversation, as an SAA tool versus something I would say that is more theoretical or research-based in nature. So actually thinking about those as SAA drivers on a multi-year basis. We also can look at long-term capital market assumptions as well, long-term asset class forecasting. Those are more like, called like 7+ years. Those take a longer duration to come to fruition. But really, whether it's strategic or whether it's tactical, we want to make sure that we have a sound, robust, research-based process that is going to add value over those requisite time frames. So 6 to 18 months for tactical and 3+ years for strategic, and then blend those two and make sure those ideas in concert actually have diversifying properties and kind of benefit each other respectively. So that's how we think about the SAA TAA piece. They're very much customizable levers. You have some clients who want to be very much strategic. You have some clients who want to be very much tactical, but kind of in default mode. That's typically how we think about employing and implementing strategic and tactical asset allocation.
Got it. I thought it was interesting, but it makes sense now that you think about factors like low vol, potential quality as being part of the tactical sleeve. Fantastic. Well, Chris, thank you very much. That's it today. Thank you, everyone, for tuning into our Investment Unlock podcast, and looking forward to speaking to you again very soon, Chris.
Thanks, Chris. Looking forward to having a successful series of podcasts going forward.